I do want to call your attention, everybody, to what's happening with the Dow Jones Industrial Average at this very moment. You can see stocks have really taken a turn down. Granted, they're only down 20 points, but it certainly has been a precipitous fall, apparently on some headlines that you're looking right at the bottom of your screen, that the president apparently wants $200 billion worth of tariffs on China goods, despite the talks. There was some news the other day that the White House perhaps was seeking new talks with China. We'll have to see how all of that develops, but you can see how sensitive that issue remains in the market. Erin, with David Tepper, talked about it yesterday. We'll hear from him in just a moment on that, but give me your thoughts both on the late innings and what we're seeing develop here as it relates to trade.
So typically in the late inning, which is what we define as 6 to 9 months prior to the onset of a recession, typically you actually see stocks perform really well into those last 6 to 9 months, and you see really a blow off the top. The S&P usually is up about 20-25% in the year preceding a recession. Now, I actually think we're a little bit earlier in the cycle than the last inning, eighth inning. I think we're probably 6th or 7th inning. But either way, I think when you look across the globe in terms of where people can actually get opportunity to make a real return, U.S. equities, I still think, look really attractive. And I think that when I look at the warning signals for an onset of a recession, it's probably 2020, late 2020, not 2019. So I'm a little bit more optimistic. I do think, that said, that having a little bit of dry powder here, waiting for a better opportunity, waiting to see after the midterms and after these tariffs are imposed what the situation looks like, I think makes a lot more sense. But David didn't say he's taking all of his money out of equities.
Oh, sure, no.
He didn't say that he's shorting equities. He's just saying he's taking a little bit of risk off here, keeping some money on the sidelines. And I think that's a smart way to play it right now.
And one of the reasons, frankly, is because of the very news that we're watching as we come on the air. And as the Dow Jones Industrial Average, as we said, takes this turn, that the president reportedly still wants $200 billion in tariffs related to China. Let's listen now to what Mr. Tepper told us yesterday about why this is so tricky.
If we do the tariffs on China, that's going to make it a little bit tough on the market here just going forward. I don't know if that's an inning question or not an inning question, but it does get to valuations and where we should be if we put on a lot of tariffs. And I'm not saying we shouldn't or should, but I'm just making it factually that's the case. So I don't know how that's in the market. And the other thing, if we don't have it, then, we'll probably have, the question is how fast will the economy go? Because China is stimulating, and they're stimulating because I think the tariffs are coming. And so that might have the fact of pushing us over into higher interest rates. So it's kind of getting a little tricky at this point in time.
Well, there you have it.
Can I just say one more thing?
Yeah.
Who in this desk thinks it's a coincidence that Trump's saying that on the day that the Manafort plea came out? And that's what makes it so hard to manage this. And that's when Dave's concerned. Very, very tough to navigate this kind of market when you're getting good news about China, then you've got this let's misdirect play by talking about the politics. So just one of those issues.